Rates should be coming out any minute now. Got the SPY up. Should pop up in the news here. We'll see if that actually happens or not. Kind of an interesting morning. We had some good earnings that actually changed the market structure. Normally, I like a flat market or a sell-off right before one of these things, but we had a climb. So we actually had an increase in prices due to a couple of companies. Google did well, Microsoft did well, Chipotle did well. All that pumped the market. So that's thrown a little bit of a wrench into my plan. I'm not sure what I'm going to do now. I have a very small position on right now. I was trying to catch a little bit of this downtrend right here. I did, but I'm still holding it. I was kind of thinking maybe if there's a big panic right when the rate comes out for that first candle or so, I might dump it into that and then look at going long if things look that way. But at this point, I'm actually not sure if I really want to do anything. The market's being a little weird right now, so it might be better to be safe. I mean, I'll probably be mad if I miss out on some stuff, but for right now, I don't know. So it is just about to be 11 o'clock. Let's open up the news here. Hopefully everybody's ready for this Fed meeting. We got the rates coming out here any minute now. Actually, it's 11 o'clock, so they should be out. Federal Reserve raises rates by 75 basis points. That's exactly what we thought was going to happen right here. So that's within market expectations. Now, we're going to see a little bit of some movement right here. You can see that the candle is actually moving pretty quickly right now. We've got some volatility. It's actually pumping, which is not surprising considering this is what the market was expecting. It's really not doing anything right now. I would like a little bit of a panic because usually there's something. There we go. There's a little bit, but look at that. It gets rejected right away. So we've got some volume coming in. You can see this candle's getting bigger and bigger right here. We're not really moving. So that's telling me people were expecting 75 basis points, which is obvious. If you read anything, it said it was going to be 75 basis points. So it's in line with what we thought. So right now, basically what we're waiting for is we're waiting to see if we can get a trade in. And right now, my puts are getting crushed. I should have let it go before that candle because the puts are going up, which I expected. I actually expected it to kind of pump a little bit because of the way that the market was opening. Once you see positive market action because of a few strong company earning reports, then you're going to have some strength throughout the day. And that's what we're seeing right now is the news that was expected was that this was going to go well. Oh, man, I should probably. Okay. I'm actually going to make a little trade here. I might have missed it, but I want to get in on these. I'm looking at the TQs. That's actually a 3x leveraged QQQ ETF here. Oh, man. I'm going to miss this, aren't I? No, I don't want that one. I don't want that one. Got to get in on this one. Let's see, what's the spread on this thing? So 182 to 190. Get that at 190. What if I can get it for like 185? No, that's too low ball. I'm just going to go for the 190. Get in on this thing right now. I might have missed it. Come on, go. Let's see, am I in? All right, I'm in. I got one. I got one on the TQs now. I got a call going up. It's a little bit out of the money right now. Let's see, whatever, about 3 strikes out of the money. So right now the TQs are at 29.83. I've got the 31 calls right here. Are we going to see anything up in that direction? I don't know. I just got in to see what would happen, but let's back up a little bit and see if maybe we can get some perspective here. So yeah, we've got pretty good green candles right now. The rate was exactly what they expected. I don't expect this pump to last for very long. I might have to get out of this thing relatively quickly, but there's not a whole lot of gain in it right now. I mean, it's not, I should have been in when the thing was right in the middle and it was kind of indecisive because we still might have a drop. All right, I've actually got one long contract, one short contract, and the short contract is way too short a time span to actually be worth anything. In fact, right now it's probably down considering we just had a pump. I'm going to check this real quick. Yep, it's down a little bit. What do you know? So I'm down on both. Woo, here we go. See, this is what I was expecting. I was expecting that since I did so well last time, this time I wasn't going to do very well at all. That's why I'm going super small right now. I've got one contract in each, so it's really not that big of a deal. It's a couple $100 on the line. I'm not worried about this. Last time I went with way more force because I figured that everything lined up, you know, everything from the start of the day, everything just lined up perfectly, so I went with that trade. Today, things are not lining up. I'm having a weird day. The market's having a weird day. I'm not sure I really want to go hard in anything right now. And look at that. Of course, I'm getting crushed, right? What are we at here? So look at that. Now we're back. See, this is where I should have been buying stuff like that if I was going to do that, which I did. So the question is, do I average down and continue this, see if I can get something out of it, or what? Because usually the rate decision comes back to a more neutral level or even a lower level after the initial pop. So I did exactly what I shouldn't have done. Got in at the top because I was seeing the FOMO. I was thinking, crap, I need to get in on this thing. And now look at what happened. Luckily, I've barely lost anything. I've lost like $5, $4, right? I've lost $4 in this thing. It's not even, it doesn't matter right now. But that's okay. That's okay. So am I going to average down? If this thing drops a little bit more, I think I'm going to dump my put and average down on the calls a little bit just to see if I can get anything when Jerome Powell talks, because this is looking more in line with what I was hoping right here. I wanted this little drop that we're seeing. So we had a bit of a pump. Like I said, that first candle, these are 3-minute candles. So let's, if it was a 5-minute candle, this would have all been one thing right here. That first like 5 minutes, you'll see a whole bunch of volatility, which you are seeing right now. And right now we're coming down, we're testing VWAP, which is an important test because all day we've been above VWAP. Look at that every time. So this line right here is the volume weighted average price. It's an average price based on how much trading has happened through a previous period. In this case, I believe mine is a 2-day average. It might be a week, but I think it's a 2-day. But what it tells you is that the market is happy. Right? If it's above VWAP, the market is happy. It's a nice green day. If it's below VWAP, the market is unhappy. It's a red day. So right now we've got a green day that keeps bouncing off of VWAP. You can see every time it came up, like it shot up right in the morning during the open, which is no surprise there. That's where most of the volume comes in. You can see right here, there's a big volume spike at the open. Very normal. But it popped up and came back down, tested VWAP, bounced up, tested it again, and it went running. So this is about where I started to get puts up here. And I had to come over here and get ready for the stream. So I didn't get a chance. I would have probably gotten rid of them right here at VWAP, but I didn't. So now, luckily, my puts can be happier because everything's going down now. So now we're looking a little bit more in line with what I was hoping. We've busted through VWAP, but it looks like it's having some resistance getting any lower than that, which is good. So that tells me that buyers are here. Buyers are ready to go. So what they're waiting for is Jerome Powell. That's the normal thing. You get that little burst of energy right when rates are released because people are trying to figure out, you know, what are we doing based on that. The algos have pre-programmed reactions to these things. So they're thinking, all right, 75 basis points, I do this. 100 basis points, I do this. 50 basis points, I do this. And you got a bunch of those doing it all at the same time, causing turmoil in the markets. So, all right, we're getting that drop. This is what I was hoping for. What's that call at? Ooh, now the call's down a little bit. So the call is down about 15 bucks. Ooh, so I'm in so much pain right now. So this is why I didn't want to get too much, because I figured this kind of thing was going to happen. Now the question is, do I buy another one? Do I buy a lower strike? Do I buy something in a different product? Because right now I'm using the leveraged Qs. Normally I've been trading the Qs during these Fed meetings because the Qs are one of the more beat up sectors. Tech has gotten hit really hard, and there are some good companies in tech. I mean, you got to think like Apple, Amazon, Microsoft, right? All these AMD, like so many different good companies are in this index. So it's not a bad idea to try to play it if you wanted to go for a bounce or a drop or something like that. So look at what we got going right here. It tested VWAP and it bounced yet again. So we've got support. The market is happy right now. This is telling me that if this pattern continues, we're going to have good luck during Jerome Powell's speech. But if we get a little pump before then, that's not as good of a scenario because that takes away some of the possible gains. It's like, let's say you've got a bottle, right? You got your soda bottle, you shook it up. You can release a little bit of that pressure, just turn the cap a little bit, you know, let some of it out and then open it up all the way. And you're not going to have that explosion because you're going to let some of it out. And that's kind of what will happen if we get a rally before Jerome Powell talks. So how much time do we have left until he talks? We've got about 20 minutes. So far, we've had a little bit of a pump and some of a drop here. We're seeing it struggle to stay below VWAP. It's kind of trying right now, but you can see right here that it's really getting rejected. I mean, we've got these wicks going right here, and all day long, downward price movements were rejected. They were kind of holding at this level, and 75 basis points was the guess. The market wanted that as the rate hike, and that's what they did. So this is a positive thing for me, the fact that it's actually dropping now. I was a little worried with the market going up, but I thought, okay, the reason it's up is because good companies reported strong earnings, which was somewhat expected because we had such a bad earnings season last time. So the bar was set pretty low. And we've had a little bit of a mixed earnings season so far. We've had some companies that didn't do well at all and other companies that were doing just fine. And that's kind of what happened last time. There was so much fear in the market and a bunch of companies really didn't do that bad. They actually did relatively well, but they guided down. And that's what caused the fear and the panic afterwards. So right now we're kind of seeing a mix. Some companies are guiding down. Some companies like Snapchat refuse to provide guidance at all. So Snapchat's an interesting one. I still have some calls in Snapchat. In fact, I'm going to load up on those calls because it got just murdered in this last earnings season. And even before that, it's been in such a downtrend. But it's a mover. It's a high mover, and it likes to surprise on earnings. So I'm going to be looking at leaps for the future to get in on that if it jumps at the next earnings season. And that's what I was talking about before they reported. Last week and a couple of weeks ago, I was saying that if Snapchat doesn't move, or any of these companies don't move this earnings season, and even better if they guide down yet again, then that leaves the possibility for a huge jump at the next earnings season. So that's what I'm waiting for. I'm waiting for all this tension to be relieved, because people don't hate the market. They're not confident in how it's going to perform in the short term, but they don't hate it, and they're in it for the long term. So they're going to come back when prices start to come in. When that bull market comes through, there are going to be buyers ready to push the market up. That's what I'm hoping for. I want an environment where there's a lot of pressure. There are a lot of buyers sitting on the sidelines waiting to go. And then the rest of the crowd has already been pushed out. The FOMO crowd, the late to the party people, they need to be out of the market. And most of them already are. So right now we're in a decent position to eventually hit a bottom. And that's kind of what I'm thinking. Like, a lot of analysts have been suddenly agreeing with me, which I'm not happy about. See, when I first started trading, I wanted to know things. I wanted to know how the analysts got their ideas and how, like, why they were feeling the way they were feeling about things. Well, eventually I picked that up, and then I started forming my own opinions, because I realized that the media isn't always there to help you. In fact, a lot of times they're there to push an agenda, or they're there to get clicks, views, etc., to make money. It's not that they're trying to actually make you a better investor. Yes, there are people in that space that are and are giving good advice, but for the most part, they're doing it for their own reasons. So you have to take everything they say with a grain of salt. And that's what I learned how to do eventually. But now that I've formed my own opinions, I've noticed that when my opinions start lining up with the analysts, that usually means there's a change in the market. Right now, I'm just kind of waiting. Want to see what the market does. Look at this. It's relatively flat. If you look at where it was right before the rate announcement, which would be this high volume spike right here, you can always tell. 11 o'clock, boom. But look at where we closed, right there. Right? And that's exactly where we are. We're pumping up a little bit now. Right? So my call, basically, it's down a little bit because I think some of the volatility has come out of it. But I'm considering loading up on these. I mean, this is a leveraged ETF. If you think about options, they're already leveraged in general. And then when you get something like TQQQ, you get even more leverage. TQQQ is a 3x. So this moves 3 times faster than the Qs actually do. And what's nice about it is it has a lower price. It's sitting at 29 bucks right now. So I've got the 31 call, and if it could easily pop up there. In fact, let me switch this screen over to TQQQ, because I've got the SPY over here on the left. We can maintain what's going on with the SPY by looking at that. Let's open up news. Actually, real quick, before I get into this, let's just see what we have news-wise. So Federal Reserve issues second 75 basis point interest rate hike. The important signal, it's sending for inflation. Let's see, there's some Russia news. Russia tells NASA it plans to stay on the International Space Station. Okay, that's going to cut some headaches out. That's good that they're not doing anything there. Let's see, FOMC strongly committed to returning inflation to 2% goal. Of course, that's what they want. They want to get inflation down to a 2%, because that's about where people don't notice it. See, the Fed's balance sheet reduction will accelerate in September as planned. That's good. So they're staying, see, everything's saying on target. This is why I'm saying a lot of this is bullish right now. That's why I wish there hadn't been that pump in the morning, because we'd have a little bit more pressure to push upwards. That's what I want. I want the pressure, because last time that gain that I got, I made 50% in 12 minutes. It did finish the day higher, but after that, the market trended down for a while. So we're kind of looking at a point where that could happen again, where if there's a pop, I want to take my gains because it could get taken away so quickly. Right now, there's so much pressure on the market that any gains you see, you need to take quickly, because there's a good chance that they'll get crushed. And if you're betting on the downward motion, that's going to be tougher too, because the lower it goes, the harder it's going to be to get lower without more bad news. Because what the market's doing right now is it's pricing in the rate hikes, and it's pricing in everything that's going on in the future right now. So what the Fed is doing is affecting how the market's going to be priced going forward. So I want to make sure that I get out quickly and then watch the trend, so I can make moves on other things once everything has settled. I like to trade when the dust is settled, because it's really hard to see for me. Some traders are really good in the heart of everything, in the volatility, in the moment, but for me, I need to be a little bit more certain. Things have to be calm. I like an upward movement after the downward movement has been exhausted. And that takes some patience, and you're not always in at the right time. In fact, you're rarely in at the right time, but it's a chance to actually get something that's a little bit safer with your money. And that's what I'm trying to do. Like, I can't really afford to lose a whole lot of money, so I have to be careful with what I'm doing. So let me see. I'm going to take a look at, oh, look at that. So the FOMC voted 12-0 for the 75 basis point hike. So they all agreed. Last time there was one dissenter, and that person was saying that the reason they dissented was because they were worried about things moving up too quickly and causing harm to the economy. However, if they're all voting 12-0 in this one, that tells me that they're not as worried about crushing the economy, because they think inflation will do that if they don't catch it quickly. And that's true. They need to get inflation under control before it becomes a problem. All right, let me check comments real quick. Let me see if I got anything. Hey, Kajichi and Future Space G, how's it going? Only trade seemed to be like a buy. And I've been green like 90% of the last 2 weeks. Tomorrow is going to make me sad. You know, I'm not sure, Kajichi. We'll have to see. I was kind of saying this earlier. Analysts have been agreeing with me, you know, and I'm starting to think that could mean that maybe we're getting close to a bounce. I don't know. Like, in my head wants to say that there's so much more downward motion coming up, that the next few months are still going to be down because, number one, rates are high. Number two, Russia is still going. Number three, shipping is still a problem. I think it's starting to clear up, but it's still a problem. The lockdowns in China are easing. That's a good thing. That was one of the pressures. So I think there's a chance that we might either be close to a bottom or be bottoming soon. And I mean, this rate hike could be it. This could be enough to crush commodities enough to bring oil down to a more manageable level. I mean, that's what they're really trying to do. Yes, everything is high, but oil is kind of the driver of everything. So when oil prices go up, the S&P tends to drop. So what do we got here? Rates are high, and Biden is almost outright trying to start World War III. Maybe, I don't know. I hope not. That's the thing. Like, if the United States gets involved in this, that's going to mean so much turmoil for the markets. Some companies are seriously going to benefit from it, but other companies not so much. I do think a bunch of that is fear-mongering, though, like the whole World War III thing. I think if you look at the left and the right, they're kind of using that in an incendiary way. You know, it's a way to get clicks and things like that. There's definitely a danger of stuff like that happening, and I mean, there's a lot more turmoil in society than there used to be, but a good percentage of that is clickbait. You know, and it could be a self-fulfilling prophecy. We might be fine, but then we could bring it on because of all the craziness that's getting stirred up. So I try not to get too into the political side of it, because that can cloud your judgment with trading and with investing. There was a perfect example of when Trump was elected. There was a tweet this guy put out. He sold all of his stocks, his entire, his pension fund, everything, because he thought Trump was going to blow up the world or something like that. And of course that didn't happen, and the market went way up. So the guy missed out on some huge gains. You know, and I'm sure the exact same thing happened with Biden, because I was always hearing, oh, he's going to, you know, do this, that, and everything, going to crash the markets. Either party is going to be beneficial for the markets, because deep down, I mean, they're all in bed with the companies that make up the stock market, right? They're all being, those companies are lobbying, those companies are donating campaigns, there's little kickbacks and things like that. So it's going to be positive in either direction. One could be slightly more positive or negative than the other, but overall, the market's going to continue to do what the market's going to do. So let me go back here and see where we're at with the Qs. I'm going to close this. It looks like we haven't had any new news recently. Basically, everything's saying they got the 75 basis point hike. The CHIPS bill has passed the Senate. All right, 64-33. Okay, so that is bullish for tech companies. See, I recently bought AMD, and that's great for AMD. Companies like NVIDIA, anybody that has to do with chip manufacturing is going to be happy about this, because this is going to provide money to build more facilities. I think Samsung was talking about building a facility in Texas if this thing passed. So we've got a few companies that could benefit from it. I actually need to do a little bit more research, but the fact that I don't really have another tech company. I mean, I've got Verizon, which to me, they're not tech, but they kind of are, because they're dealing with internet access and things like that. But AMD is a more true tech company, and I just like them. You know, I've liked AMD for a while. So let's see. Let's zoom in here and see what we're doing with the Qs real quick. Still relatively flat, right? We've had these little pumps. This is why I say I don't really want to play this, because this is kind of what happens. If you're selling like iron butterflies or iron condors or something like that, where you want the price to stay where it is, this is a nice setup for that, because you could, when it's pumping up, if you sold some calls and then waited till it dropped a little bit and sold some puts, kind of took things off as it trended sideways in the middle, then you'd be pretty good. What do we got here? Barbarian Blast Machine. How about NVIDIA? I like NVIDIA. I think they could benefit from that too. NVIDIA is a great company, actually. Here, let's go to NVDA and take a look real quick. See, NVIDIA is looking good. See, any of these companies right now actually are a good look if things pump on Jerome Powell's speech. So I'm going with the indexes, but individual stocks would be good plays too. Not just in the long run, but today if things look like they're going well. In fact, let me see, when does NVDA report? So they're a ways out for the reporting, unfortunately. But I do like NVIDIA as a company in general. I actually considered buying some. It was like between them and AMD. I just like AMD because I've used them for a long time. I like their growth prospects. Also, NVIDIA is extremely expensive. They were up in the 300s, you know, and I bought AMD not that long ago, actually. I bought AMD in the 70s. I think it's in the 80s or something right now. But NVIDIA is a great company. Absolutely great company. I love, if I could have my fantasy stock portfolio, they would definitely be in there. But since I have to choose, you can only have so many stocks, I'm going with AMD. They are slightly different in some ways too. In fact, NVIDIA will probably pump if things are positive, because look at what it's been doing all day. It's following the market. I mean, it's weighted heavily in the indexes, so I'm not surprised, but it's doing the same thing. And when it goes below VWAP, it pops up, goes below VWAP, pops up, so it's looking good. How about Intel? See, Intel's been struggling a little bit more lately. Let's take a look at them real quick. I haven't paid as much attention to Intel, but I know they had some problems not that long ago. A few weeks ago, they were reporting that I think it was the chip shortage was going to hurt them, material shortage or something like that. But they're not a bad company either, and they're still going to trade like the market. You can see it's doing exactly what NVIDIA was doing, because it's popping up and it's going above VWAP every time it pops down, because it's another good company. And that's the thing I like. Like a company like Intel would be good to get while they're struggling, because eventually they're going to pop up a little bit. So what do we have left on time here? Ooh, we've got 6 minutes until Powell. Let's just make this thing a little bit more noticeable. Oh, great. No, I did that. Okay. All right, so it's a best today. Hope everybody else is having a better day than me, man. I had an interesting day. I just, from the time I woke up until now, I just wasn't feeling it. I was thinking, man, I probably shouldn't trade today because everything just doesn't look right to me. Okay, so we've got that. We are waiting. How much time do we have left? Ooh, 2 minutes. Okay, so 2 minutes before this rate announcement comes out. This is extremely important. I don't like the fact that it's already pumping. It's a little, it's flat, yes. I can see, you can see it's right here, maybe at the top of this range. But I was hoping more for a hangout at VWAP. This is not, this is already taken a couple of, 30 cents. That's actually not that much, because I'm hoping for a couple of dollars. Last time the indexes pumped a few bucks a pop. I think I went on the Qs, the regular Qs, and that went up like $5 or something like that. That was enough to make a 50% profit in like 12 minutes. So that was nice. That was one of my best day trades ever. I don't really do day trades very often. I was really hoping to actually get one today. I've been thinking, man, I really, really want that trade. But you don't always get what you want, right? Hopefully that song, you don't get what you want, but sometimes you can get what you need, reigns true, because I need a trade. I need a trade. Let's do this. Oh, 4 seconds. Okay, so Jerome Powell's not going to come out right away. There's going to be a little bit of a thing. Okay, actually, hold on. I have to unmute. You haven't heard anything. I have to unmute this stuff. I'm looking at buying another contract right now while we wait. Powell's going to be, oh, the door's opening. Here he comes. J. Powell, let's do this. Are you ready? Better be ready. All right.
Good afternoon. My colleagues and I are strongly committed. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From
okay, this drop is normal right here. We want to see more, hopefully.
Maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
We're going for VWAP, hopefully, but
Labor
it looks like it
demand
might
is
be
very
bouncing.
strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy.
Data dependent, very important.
Today's increase is in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
All right, here we go.
As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, everything was in line. That was what we wanted to see. But are we going to get more of a pump? I don't know.
Hi, Chair Powell.
I'm considering selling already because I'm up a bit, but not that much.
Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
In other words, exactly what they said they were going to do.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how is the committee's thinking changed?
I need that 31. I don't know if I'm going to get it, but I need 31. Let's do it.
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target.
Restrictive, remember that. That's an important
word. It's also worth noting
word.
that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive.
Okay, I unloaded one contract because I don't like this this settling right here. It's kind of
currently implies you will
topping
raise
around
rates
340.
along the lines
Might
of
keep
your
going, but
June SEP,
I don't know. I don't like the feeling, so I dumped one just in case. So I'm
a
up
few
a little
months
bit.
later
All right,
next
still
year.
up on the other one.
Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times. In normal times, what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina.
Everything's in line so far. Exactly what they've been saying for the past couple of months. This is great.
Hi, Jerome. Thanks for taking our questions. Gina Smilek, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
That is a great question.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both. And we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we're not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned,
Nash and Phoenix, what's up? We're looking at the Federal Reserve rate decision. Jerome Powell is talking. I've got a trade on. I already took half of it off. I'm still writing the other half of the trade, and we're going to see if I can get anything else out of it. But right now, it doesn't look good.
Reopening year
for
of
more.
2021. You're also seeing tighter monetary policy, and you should.
Well, we're going to find out, Kijiji, on Thursday. GDP numbers come out then, and we'll see if we're in a technical recession at that point.
So that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we.
Yeah, everything's pumping right now. That's why I'm in the TQ calls.
Probably necessary if we.
Good for you. Make that money, Kijiji. That's how it's done.
Back down on a path to 2%. Ultimately, get there.
All right, we'll see one more question, and then I'm going to wrap this up and talk about everything. I'm thinking about getting out, but I'm still in that trade.
On getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks.
All right, my last limit order got hit. I am out. 25% profit. All right.
We're trying to do just the right amount, right?
That's how it's done.
We're trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Oh, I love it.
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and
oh, this is ridiculous.
Imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later.
I agree.
To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Okay. I'm going to go ahead and call it there. Let's mute that. We'll leave it on so we can see when it finishes. All right, so that was an interesting trade. I did another day trade during the Fed. What do you know? What was that word salad? Yeah, I know. That's what he does. They have to do that. They have to confuse people. When you've been watching financial media for a while, you start to understand it, and it's actually kind of interesting. But a lot of it is word salad because, most people don't understand, and it's a way to keep people calm without having to alarm them. Oh, look, it's going to pump now again now that I'm out. But okay, so that was an interesting Fed meeting. It didn't make quite as much as last time, but I made something. So what do we have here? An Ash and Phoenix. And I've been factoring inflation into my budget. Yeah, you have to. And that's the thing we're gonna see with the next CPI number, which isn't going to come out till next month. So we have a few weeks before that. If anything has come down, my guess is that it's not going to be down yet. I think it's still going to be high. In fact, I think the next like 2 numbers are still going to be high. But if they're under the peak from the last reading, then that can show you that maybe it's starting to come down, maybe it's peaking, because it takes time. You know, it's not going to just come down instantly. And these things have to ripple throughout the market. Would you say here in Ash and Phoenix? Did he ask, if you screw up, in which way would you prefer to screw up? Yeah, he did. That's why I was laughing at that question, because it's actually not a bad question. It's like, I watch a lot of baseball, and they kind of say that with pitching. They're like, all right, if you're going to miss to the inside or miss to the outside, depending upon the pitch, because if you do it the other way, it can be catastrophic. And it's the same thing with the economy. He's basically saying, all right, if you pump this thing up too hard, is that going to be worse than not pumping it up enough? And my answer to that would be probably. I mean, they have to hit this now, and it's going to be difficult. They're trying to front load all these rates, get everything done initially so that the pain doesn't last that long, because that's what we want. We want them to basically just come in, chop the prices down real quick, and come back out. That's the hopeful way of going, but I don't necessarily think that's what we're going to get. I think it's going to be a lot more messy. We still have a lot to get through. All these rate hikes that we've had recently have been high, but they're not on the upper end of the estimates, because there was a lot of talk of a 100 basis point hike. And if they did that 100 basis point hike, I think we would have had a completely different reaction from the market. I mean, everybody was kind of thinking about a 75-point hike, which they did. It was in line, and that's good. Usually the Fed is going to be in line with expectations, and part of that is because the financial media likes to pump up the negative side and make you think it's more likely than it is. I can't tell you how many people I saw. There was somebody that was saying, oh, it's going to be 125. Pin this comment, 125 basis point. And I responded to that saying, like, I don't necessarily think that's going to be the case. It's possible, but it's extremely unlikely, because we were looking at 50 to 75, and now we're looking at 75 to 100, and 100 is not that likely, especially if you look at the Fed funds futures, right? So the futures were pricing in a 75% chance for a 75 basis point hike. They had a 25% chance for 100. They were basically saying, no way it's going to be a 50. It's probably going to be a 75, but it could be 100. And as Powell said, the data suggested that, and their feelings also suggested that. That's one thing he did say in one of these answers, is it comes down to feeling. You know, there's so much data. These people are professionals. They work their entire lives to become, Fed chairmen and presidents and stuff like that. But when it comes down to it, it's a gut feeling. And that's true, because it's the same thing with trading. Today my head was all confused because of the market pump due to the earnings that came out beforehand. But when I saw the reaction that I saw, I got in right about, let me give a mouse over here, right about here, which is the same story as last time. I got in towards the bottom last time. It wasn't perfectly. I actually got in somewhere with one contract up at here, and that contract was down, so I added somewhere in here, and then they were both up now. Of course, I'm out of both contracts, and they're up a little bit higher from where I sold them, unfortunately, but that's totally fine. I made about a 25% profit on that. Maybe it was a 20%. I wasn't exactly sure, because I sold them at different times, and I was paying more attention to the meeting than the actual percentages. But that's still a good gain. I mean, I don't day trade very often, and these last 3 day trades have been really good. So when are they announcing it? They already did. They announced it at 11 o'clock. It was the 75 basis point hike. And then Jerome Powell comes out half an hour after that, so 11:30. And that's the important part, because he starts telling you about everything. He tells you about the plan. So it wasn't just the rates. The rates are only one piece of the equation. The other piece that's actually, I don't even know, it might be more important, is the balance sheet. They were buying junk bonds. They were buying regular bonds. Basically, they were buying bonds from companies that needed money. And now they're running those bonds off their balance sheet. So that protection that the market had for the Fed absorbing some of the supply is going away. What they're essentially doing is they're adding supply to the market to drop the price of bonds and everything else. So the interest rates are making it harder to borrow money, and the balance sheet reduction is adding supply to the market. And in both cases, they're trying to drive prices down, because a lot of the prices were coming from speculation. So the interest rates are crushing the speculation, i.e. people just betting on stuff and bidding the price up to insane levels. usually on things that don't matter, right? Because yeah, you'll see a pump in like Apple and Amazon and stuff like that when the market goes up. But when you have a huge bull market like we had last year, you have people dumping money into companies that aren't earning anything, companies that are burning cash and have a projected profit of like 2024 or something. So it's like, oh, we're going to be profitable by Q3 of 2024. All right, let's dump billions of dollars into this company. And then they do that and everybody else freaks out and they dump money in there, and it's just, it becomes crazy. And that money isn't just in the market. Like that happens in life too. Like commodities, i.e. all the stuff that you buy at the store, right? All the food, you get the energy, anything that's sold in bulk, those get bid up and make it more expensive for everyone else when we go to the store. So taking away the cheap money is a way to get those prices down, and running off the balance sheet is a way to add supply and drop the market price of everything else, hopefully putting enough weight and pressure onto the market to fix this problem in the economy. And basically that's what he was saying. I'm probably gonna have to watch the end of this because it looked like he was about done, but they're still going. That's what he was saying, is they're gonna try to keep the market stable. When they talk about price stability being important, they're serious, because that's what they're trying to do. Everything they're trying to do is to keep prices at a stable level so that people can afford them and there's not all this volatility. Right now it's difficult to do with the headwinds that we have, but they're trying, and they're probably going to succeed. People think, oh, they're not going to be able to do it this time, it's going to be worse than 2008 and blah blah blah. Maybe, but I don't think that's the case. They still have plenty of ammo, right? The balance sheet is extremely full. They can jack rates up as high as they want, but the people that borrowed money and are having to pay things back more expensively now, they're hurting. So they don't want this to continue. Let's see. Well, we hope they don't break the economy more, seeing as we're looking at potential food shortages. And that's the worry. See, the other problem is if they act too aggressively, like they raise rates too much, they can actually make the problem worse. And that's what they're trying to do. And that's why when people were saying, oh, it's going to be 100, oh, it could be 125 basis points, I didn't think so, because they don't want to be so aggressive that they hurt everything, right? They're trying to be as aggressive as they can without hurting things. And that's what this 75 basis point rate hike was. It was a good choice. If I was on the Fed, which, I'm not an expert or anything like that, I would have voted for 75 basis points because it's aggressive enough, but it's not so aggressive that it's going to hurt everything. So the question is, now that we've had this rate hike through the pipeline, it's out of the way now, we've got the period of time where there's going to be no Fed meeting, and they're basically just going to let these policies work themselves out. They're going to see if this stuff actually helped in the economy. So the next two CPI numbers are going to be extremely important. I don't think they're necessarily going to come down yet. Like I was saying before, it's probably still going to be high, but if it doesn't continue to make new highs, to me, that's a good sign. If it's somewhat in line with what it has been, or even a little bit lower, I consider that a good sign too. They're going to be the naysayers that say that it doesn't matter, it's not working, blah, blah, blah. But that doesn't necessarily mean that's true, because some of these people are just looking for clicks and views and things like that. So basically, we got what we were looking for. Overall, this was a good Fed meeting. It was better than I expected. I didn't think I was going to make a trade this morning. I thought, oh man, it's already pumped. It's over. They've let the pressure out of the bottle. I don't want to get in on this. But luckily, we had that nice volatility right when everything came out, and it was basing here. Like right around here, I mentioned we're looking for a tap of VWAP, and it barely got it on this candle right here. All right, I'm going to go ahead and just close this. So you can see right here, this candle, it was like right after, so 11:33, it bounced. I don't even think it touched VWAP, but it just barely hit it and bounced right off of it. And you can see before that, when we had the high volume and the high volatility, starting here, because you can tell by the volume, this is where the rates were announced, we had this range, right? It went up a little bit. This was actually when I bought the first contract. It was going up. I bought it like up here because I was starting to get a little bit of FOMO. Right, so I fell for it. I did the exact thing that a lot of traders do, but I went in light. In my head, I knew this was a FOMO buy, which is why I only bought one contract, and why I waited until it went down, bounced off of it, came down again, started to bounce. I thought, all right, here it's time to add contracts to it. So I did, and bam, right at the right time. It went up, let one contract go somewhere in here. I think it was like close to 30, 40. Yeah, somewhere around here, and then the next contract, I think I let go in this red mess right here, which was nice. So together they got about a 25% profit, which was great. That's about half. I got 50% last time, so 25% this time, not too bad. A little extra cash to add to my my pool right now, which I need because my cash has been dwindling. I've been buying things. I've been making little random trades that are still on, and then there have been a few little random losing trades too. So my cash has been dwindling, and it kind of sucks because I wanted a little bit more for this point, but that's what happens. When you get a decline, you have to grit your teeth and buy when you feel it's time, and it's not going to be at the bottom. You're going to get hit more, and that's what's happened. However, I still have enough cash to do something like this. You know, I wanted to make sure I had some cash to make some trades. I actually had about half as much cash as I did the last time, but it was enough to make something, you know, and it wasn't a ton of money, but hey, whatever, I'll take it. Get 25% on a few contracts. I still have that put that expires this week or something like that on the Qs. That thing is annihilated, I guarantee it. I haven't even looked at it. In fact, let me see what it's at right now. So that thing is, yeah, it's about half right now. That was mostly just in case there was a massive tank. It was more protection than anything else. I figured there was going to be a bounce, but just in case things went the other way, you know, there was some unforeseen event, then I wanted to have protection just in case. Because if that thing went down, if this put ended up being in the money, that thing could have been worth a few $100s, which would have covered a lot of the cost of the calls if I bought them, right? Which I did. So the put I bought this morning, when it was kind of peaking, I actually could have taken a little bit of profit on that put because I got it at just the right time. Here, let me go over here and back up a little bit so you can see where I got it. So I bought the put like right in here, right around this peak. I thought, okay, this is looking toppy. We've got a rate announcement coming up. There's a good chance that this thing goes down, and it did. But during this time, I was traveling over to the other place, getting the stream set up. I forgot my power cord, so I had to go back and get that. It was just like, it was a mess. And by the time I was ready, it was like right in here. You know, the put was starting to, things were starting to come back up, and the put wasn't as much in the, it was never in the money, but it was down. I mean, it was up and it came down. So that put I'm just going to hold just in case we get a drop tomorrow, because it would be nice to you know, get out of that thing with a little bit of a gain. And the last few Fed meetings have done this exact thing. They pump up on the day and then they crash down. However, the last pump came all the way back down to VWAP before it bounced. This one's kind of holding up at the highs right now. And if it gets to 31, then I'm gonna be pissed, because that was where my strike was, and I could have made a huge amount of money, because these ones are leveraged, and when they're in the money, they end up coming up quite a bit. Let's see. So your insurance broke. No sarcasm. Yeah, it is insurance. Let's see. Does that mean your crumple zone cars did its job? If I'm understanding what you're saying in Ash and Phoenix, it is insurance. Like, options are basically considered insurance. You buy them because you are afraid the stock is going to move against you, and they're a way to protect yourself. Like a put protects you if the stock drops. So if, let's say you got a stock at $100, you buy the $100 put and the stock goes to 80, well, you still get to sell your shares at $100, so you're safe. You're only down whatever you paid for the put. So it's exactly like insurance. And if you don't need that insurance, it expires worthless. It's like your car insurance, right? You pay your car insurance. It ends up expiring, you know, because you don't have an incident. So you gave them money for absolutely nothing in that quarter. And that's the same way options work. If you need them, they're worth quite a bit. But if you don't, then the seller of the option is the one that benefits, because they collect your premium while they're holding the risk. So in this case, I didn't really need the put, but I had it just in case there was an accident, right? Just in case I got into the crumple zone. Right now, oh, we're getting close to that 31. I think the market's skeptical right now, because this product should be moving a lot more than it actually did. But every meeting has come back the next day, either after hours or the next day. So that's what we want to see now. Now that the market has gotten what it wants, what do we do? If I look at the screen over here, I have a few other stocks listed. Apple down here, this would have been a good one to play because it went from 154 to 156. If you had some options on that, that would have been nice. I was here on the Qs. It's a little bit cheaper, a little bit easier, has more leverage. I got that nice little pump right there. My contracts are not that much higher than where I sold them, even though because I sold them, you know, I don't know, 30, 40 cents down from where it is right now. So yeah, that's not that much, but with a leveraged product and, you know, quite a few contracts, that actually ends up being decent. So we've got Apple listed twice. So what am I doing? You know, here's the other one I was thinking about, Ford, because it's a low price stock. It doesn't have a whole lot going on. So what did it do? Nothing. Very little movement. See, this is why I didn't go with it. I thought, man, this is cheap. Oh, FC. That's the wrong one. F. Thank you very much. Ford. All right. So yeah, Ford went up. Okay. Not a whole lot. That's kind of what I was thinking. It went from the 1280s to about 13. So not a whole lot. The only reason I was thinking about playing that one is because it's so cheap, and the options are cheap. If you can get cheap options out of the money that end up being in the money, that's a really, really nice gain. But with Ford, it doesn't move that much, so I wasn't too impressed with it. So basically the Qs they've been my play for the last 3 meetings because they're super volatile and they're beat up. And that's what you're looking for on a trade. You want something that has been beat up enough and has the capability to be volatile enough to make you that money. That's what options are playing off of. Options are looking for volatility. If you're an option seller, you want to sell during high volatility and then buy your position back during low volatility. And if you're a long trader, you want to do the exact opposite. You want to buy before volatility comes in and drives the premiums up, because the premiums are insane. In fact, let's go over to the option chain real quick. You can see I got one over here in this and weeklies. It's going to die, but right now these premiums, you can see on the call side, they're green because everything has gone up quite a bit. And you can look, like right here is where this faded line is, where the contracts are in the money. So you can see the stock is at about 30.72. So this 30.50 strike is the one that's in the money. And as you go up, you can see they build more and more and more. So if you had one of these options earlier, it would be worth so much more. What you're looking at is delta over here, though, right? So the delta is telling you how much the contract is going to move per dollar you gain. And the contracts in the money have really high delta. I mean, you're looking at 80, 90, something like that. For every dollar, they're making $80 or $90, which is why I was hoping this stock would move a little more, but it hasn't. So that's why I got out. Even though it's up compared to what it was, I didn't like the fact that it was stalling right there. And I was thinking, what else does he have to say that would pump the markets? Because he had already really said everything that was necessary. Number one, the rate announcement came out before he even spoke. Number two, he said, we're still in line with the balance sheet. It's going to do exactly what we said, so that hasn't changed, which means they're not afraid of things getting worse. The consensus to vote was 12-0. Everybody agreed on the exact same rate hike. So I thought it seems like all that news is baked in, and there's not really much more he could say that would pump stuff up, which is why I got out of it. So if we go back to the charts and zoom in a little bit, we can see that things are, even though they're up, they're still kind of stalling. I mean, there's definitely an upward trend. The contracts that I had are, what are they at now? I'm going to take a look at those and see. Yeah, they're still not that far above where I sold them. It really didn't do that much, which is good. I'm happy about that because I like getting out at the exact right time. But right now we're kind of at a point where it looks like it's topping. It might pump up for the rest of the day, or it might close right here. How much time do we have till the end of the day? We've got about 49 minutes, 48 minutes. So there could be something, but look at the volume. See, here's the other reason that I got out of the contract. Like you can see when things started, the volume was super high. That's why on this red candle right here, I was looking at like, all right, there's not a ton of volume, but suddenly right here, volume started to spike and it was basing. So I thought, all right, this is the time. Volume's coming in. That's what you want to remember. It's not just about the price and where things are. It's also about the volume, because you want that wave to carry you up. It's like if you're surfing, you sit there in the water and you wait for the wave. That's exactly what you're doing in trading. You're waiting for the wave, and that wave is the volume candle. So you want two things to line up before you get into a trade. One, you want the price to be at a level that looks good. In this case, it was VWAP, because all day it was staying above VWAP. So we thought, all right, VWAP is the support to beat. It hadn't beat it at all. Every single one got rejected, right? Even if it got close early in the morning, it still bounced. And right here, when things were really volatile, would be basically the only times that it actually touched VWAP, not counting when it opened, because that's, a high volatility area. In fact, look at the volume, right? You can see right at the open, there's a high amount of volume, and then it kind of dies off as the day goes on. Yeah, there are some fluctuations here and there, but this yellow line is the volume average over a couple of days. And it's telling you that most of the volume was out of it right there, because the average had been up due to the increase in volume right when the stock opened. But over time, you can see that it was evening out, right? There wasn't more coming in until we had the rate announcement. Bam. You could see the rate announcement brought in some huge volume, and then it kind of settled. And once it was settling down here, that was the thing that made me think, all right, we might be done with the selling because the volume is coming out of this. And number two, when the volume started to come back in, we had a nice strong green candle. So I was getting in on that one just because I thought, all right, if it's going to happen, it's going to happen. And this was about where Jerome Powell was saying, all right, we're good with the balance sheet. We're good with our plan. Everything's still in line. We haven't really changed anything in the past month or two. So that was super positive, and that was the reason I got in there. Volume confirmed it. Jerome Powell confirmed it. Price level confirmed it. I wasn't going to make a trade because I didn't like the way the market was moving, but when everything lined up, I went into it. And then when things started to stall, volume came down. Price was kind of hanging at the same level. I thought, all right, it's time to take my gains. So what do we have here? We got a few things. Future Space G, you've been watching this. This Fed guy lies so much, Lamau. Prepare for 4120 and a massive drop after. So let's go to the SPX and take a look real quick. SPX, see where we're at on that one, because I've been on the TQs for a while. Also, Sloan Fishby, thanks for coming in and joining. Good stream, homie. I gotta go. I'll DM you later. All right, man. I'll talk to you later. It's been a nice little stream. I'm glad something actually happened. All right, so it's Future Space G. Thank you for being here with me. Let's take a look at the S&P and see where we're at. Look at that nice gap up in the morning. Isn't that special? So right now we're at 40.23 year estimate. In fact, let me get to the big chart so that way it's a little bit easier to see it. In fact, I also want the indicators, which aren't going to be on the index, but let's go down here. Okay, so you're saying 41.20 is the pump. And I'm guessing you're saying that because the moving averages are lining up right here. Not to mention there's actually a little bit of support across this whole level right here. Like we bounced off of that 41 something-ish level earlier, and last year there was a settling right here. And that was actually, what, April through June? So that's a few months that it actually settled in that price range. That's not bad. If I were to look at the SPY, it would probably give me a better volume read on that. But I can see that pump happening to 41.20. I'm not sure, though. I mean, the fact that it's stalling right now, like I thought maybe it would pump more right now. But we have to see what happens in the next few days. Really, what's the big thing that's gonna move everything would be more earnings, right? We've got GDP coming up on Thursday, which is gonna probably move things. But a lot of people estimate that it's gonna be negative, and I don't know if that's really going to affect anything unless it's extremely negative. If it's in line negative, I don't think it's going to move that much. But earnings are the thing we're waiting for right now. Good earnings are going to pump the market, right? Not as bad as somebody said. Not as bad as feared is in right now. I.e., if a company reports decent enough earnings, they're going to pump. All right. So what do we got here with Future Space G? We won't get higher highs in this. Worst is still to come. Maybe. I mean, see, this is where I think you and I differ on the opinion. Like, we've been pretty much in line for this whole thing, but man, it just feels like my gut feels like there's going to be a bounce. I don't want to bounce. I want it to continue to decline a little bit more because we really need to shake out the stuff that's causing problems. However, I don't know if we will. I think the Fed's going to be... They're going to be as hawkish as they need to get this under control, and then they're going to stop because they want prices to continue to go up. In this, let's see, economy is not okay. We just didn't get the effects yet. 3,700 to 41 isn't a bounce. That's a bounce. Yeah, I would say so. I mean, we went down there, but look at how tight this bounce is. It's not moving very quickly. If you look at the bounces up here, these were huge bounces before big declines. So the other thing that tells me is, like, when there's a big up, a lot of times there's a big down to follow it. It's just like gravity. So what goes up must come down. And it's not always like that with stocks because it's not technically, it's not actual gravity. But the laws of the universe or whatever kind of apply. When there's huge moves, there's usually a retracement of some kind, at least partially. In this case, it went to that and more. But look at where it retraced to. This 41.20 line that you're talking about. It's an important level, right? So let's see. Well, it took like 2 to 3 weeks max. It's a major bounce. You think you're saying this is a major bounce from going down here. Yeah, I mean, it's in line. To me, it's in line with the other bounces. Like, look at how big this one was, right? It went from, let's see, 41 to 45. So what do we got? About 4. We'll call that a little less than 400 points. What's this one? This bounce was 38 to 41. So about 3. So a little less. This bounce was 36 to so far 40, so we're at about 4. So we're somewhat in line with what the bounces have been so far. If it goes up a little more, then yeah, I'm going to say if it actually gets to that 41.20 mark, that is a major bounce because that'll be a bigger bounce than we've had. But look at how long it's taken, right? These are weekly candles, so it's been counting this week 1, 2, 3, 4, 5, 6, 7 weeks. So almost 2 months to bounce from this point. Whereas these other ones did it in 3 weeks, right? This one was right here, and then 3 weeks later it was right back at this line, which is yet another level that is support, right? And this one right here, it did the same thing. It was 1, 2, 3 weeks, 4, 5, 6, 7 weeks. It was back to where it was. So in the same amount of time, this had bounced all the way back to where it was, whereas this one is kind of floating here. To me, it looks like there's congestion. This is looking like it could be a bottom. I think my head wants to say that this move is going to bounce and go down like you've been saying, but my gut is saying, like, it just seems so, it seems a little solid. I don't have the words to describe it, but my gut is telling me, like, you've been a bear for quite a while. You know, you can't overdo it. At some point, it's going to bounce and you're going to get hurt, because the more confident you get as a bear, the more you might do something about it. And I have been shorting little bits here and there, but because of the bounces, I haven't been going that strong. And that's kind of what I'm playing. I want to play these little bounces in a swing trade type fashion, more so than trying to get like some huge move out of everything, because I don't know how low it's going to go in fully. See, 14th of July, we're at 37.20. In 1 week, we're at 4,100. Let's see, is this the July mark you're talking about? So where is July? Yeah, I mean, yeah, these have been big. It's volatile, you know, but it's been in this range. This is kind of a range. We're sitting on top of it, but if you really think about it, these 1, 2, 3, 4, 5 candles right here, in my opinion, are a range, right? You got the low and the high, but look at every other week. Like every other week is down, up, down, up. It's so indecisive. People don't know what's going on. They've been waiting to deal with this, and I think part of this right here is the pressure releasing. I mean, the pressure was releasing early in the economy because people expected this exact outcome right here, right? So what did this? It's a major short squeeze. Yeah, I think it is. A good chunk of it is a short squeeze. True, 70% of the market had puts at 3,700. Impossible to get by that. Those needed to get burned. Short squeeze only way 4,100. Yeah, right down here, you're right. This is when negativity was super high. What's funny is every time you see a bottom, that's usually when people think it's going to be the worst. You know, it's hard to say when that point is, you know, if you just wanted to go by what people were saying, because they always say it's going to be the worst. But more people than normal stack up when something like this happens. In fact, actually, it might have been at this point right here when Bitcoin was at like 18,000 or something like that. It had a massive short interest. Tether and Bitcoin both had massive short interests at that point, and it popped a little bit. So when that happens, there's fuel for the fire, and anybody with enough money can move the market, which is exactly what happened with GameStop, right? In 2021, there were a few funds that were ridiculously short on GameStop, to a point where the shares weren't available for people that wanted to buy either. It was, the share pool was so light that it was easy to move the price up. You know, and that's kind of what happens with shorts. They take up all the extra shares, or not all of them, but they take up a good amount of those shares, and the only places to get them are the people that don't want to sell. So they sell at higher prices. And right now, with this little squeeze that we're getting, we're going to get some of that with these people. Like, some people are expecting the market to continuously go. Here, let me switch to the SPY so we can get a little bit of volume real quick. We are coming into that area, right? This is what I've been talking about for the past couple of weeks. There's this like low volume area right until we get to that 4,100 point that you were talking about, Future Space G. So I do think that this is a very likely outcome to get here. However, I don't know if it's going to happen tomorrow. I think it's going to be like it has been, somewhat of a gradual trend, because there's going to be some volatility, some people that are afraid. There's going to be people that are up and want to take profits. I mean, you've got this huge mix of things going on in the market right now that it's really difficult to get by. So I do think it can hit this point, but it's probably going to grind its way up there if it does. However, this could also be the top, because look at this trend. If you draw a line going down like this, where we are right now is kind of sitting in where that line would be. I mean, you could put that line anywhere in this range right here, but at the same time, it's still respecting this lower high and dip. Lower high, dip, lower high, dip, lower high, right? So it would have to break this level right here, was it the 41.15 level? It would have to break that level in order to get rid of this trend. But right now, we're just kind of on the cusp of it, and that's making people nervous. So what are we doing in real time, right? So real time, it's been grinding its way higher, which is kind of what I expected. So what do we have here? This is my view, trading view. Let me open this up, make sure it's not terrible stuff. Oh my gosh, what are you doing with all these lines all over your chart, man? Are you a technical analysis guy? Look at this. All right, I got to embarrass Future Space G real quick. What the hell is going on with all this? But is this where you traded? Oh, were you back testing something? Most likely test to follow rejection with a lower with lower low expected. Okay, I see what you're doing. You've got a couple of channels. So you've got this upward channel, and then you've got this longer downward channel. That's actually kind of interesting. Let's see, getting to 4120 and drop. I'm still going to make fun of you for having all these lines, though. This is hilarious. You know, it's like, it's not a bad idea to look at this stuff, but like when you put it all together on one chart, it just looks like a mess. Although I've seen some bad ones, man. I took a screen cap of this one guy. I'll have to find it on YouTube that had so many lines on his chart you couldn't see the candles. It was literally just nothing but lines everywhere. So this isn't the worst I've ever seen. You know, but it is funny. So you gotta, I'm gonna make fun of you for that, Future Spacey. However, let's talk. So what is this? This is the S&P 500 cash. Oh, this is the CFD, the contract for difference. Hey, very nice. So what is this test right here? Were you doing a back test on this, and this is where it was saying to buy, or what do you mean by that? Let's see what you got here. Channels work only 5. You've only got 5. Is that what you're saying? You got one channel here, 2, 3, 4. And then the green one, 5. Oh, yeah, you've only got 5 channels. Okay. But what you've done is actually really interesting, because you can see right here that it's respecting this channel. Like, this is almost like a standard deviation channel. Not quite, but it's very similar to it. And I can tell it's just one that you put in there with whatever tool TradingView has. But it's interesting, because look at what you got going right here, right? You've got this downward trend from the peaks, and that's kind of where it's hitting. And actually, this is what I was just talking about a second ago, but kind of in a different way. We've got that downtrend going. You're kind of zoomed in on this a little bit closer than I was. But what we're getting right here is the connection of all these channels, right? And a little bit higher, we've got the moving averages, the weekly moving averages, which have a lot more weight than the daily moving averages. So the higher it goes, the more weight is put on it. And your chart is actually kind of showing that right now. Am I able to zoom in on this a little bit? Ah, there we go. Okay, I can zoom in a little bit. So if you follow this chart for some weeks, you'll see it works in terms of resistance and support. I would hope so, man. I've been burned so bad by technical analysis. I have a hard time following any specific thing because I feel like it gets you too focused on one aspect of the market. However, if you do follow these channels, sometimes you can actually make money. You know, there are times where I thought, man, if I had just done what I thought because that technical analysis indicator said this, I would have been fine. So everybody with their own technique. Yeah, exactly. You know, like my technique isn't for everybody. In fact, there are people that do all the stuff that I hate and am terrible at, right? And then, of course, there is the branching out, like this whole day trading thing. I haven't done this. Basically, the reason that I'm doing these day trades is because I have the stream. I wouldn't have done it before. I did it once just to kind of test with a little bit of money, and it went well, so that made me think, all right, I'm going to try this again. So I wouldn't have touched it if it wasn't for this whole thing. But I like seeing these alternate views. In fact, I like this chart that you have set up because even though it is covered in lines and it looks kind of funny, there's a point to it. It's not like a ridiculous amount of lines. You're not supporting everything. Also, what is the time frame on this? Are these aren't daily candles, right? June, July. Are these like 4 hours or what's the time frame? Let's see. You went long at 38.50, was a bottom of the channel, still keeping my long. 41.20, the channel tells me to get out. So let's see, 41.20 this is where you're saying. That's why you've got that indicator right there. So you think it's going to maybe bounce off this line, kind of trend around here, and then you'll dump it when it gets up to this point. That's not a bad point to dump it, not just because of the channel here, but because, number one, it's a price level where a lot of shares traded hands. Number two, you've got good volume going in right now. Number three, the Fed is in line with everything, so that's happy for the market. And number four, your chart has been decent so far. So, you know, why not take a look at that? That's a good, I think that's a decent place to go. I'm a little bit more skittish, which is why I got out of my trade right away. In fact, let me pull this down real quick and see where we are. Oh, look at that. 40. Hold on. Let me check my contracts. If they're in the money right now, I would have been, I'm going to be a little pissed off that I missed that. Oh, they're going up. Okay. They're not super high, but they're definitely higher than where I sold them. Oh well, whatever. I still made my profit, man. That's the thing. You can't be mad about making a profit, right? I did well enough. I made 25%. That is a nice I don't know what the time frame is. I'll have to check that out, but 25% in like 10 to 20 minutes. Not bad. Let's see. Rejected the lower test, went into an upward channel. I took a long position. Simple. That was a good place to take a long position. You were right with that one. You know, technical analysis can be quite right. That's why I don't discount it. And that's why I actually use more of it than I say. Like, I make fun of it, But it's there for a reason. It has persisted for a reason, because these things actually play out sometimes. Not all the time, but if you have that and you have some fundamental stuff behind it, which is why I'm glad you're watching my stream, because I'm going to pump that fundamental stuff into your head, so it's not just technical analysis and you're getting lost in the numbers, getting lost in the lines. No, you got to be open-minded and see everything, man. I want your technical analysis here to teach me a little bit too, because it does. I mean, there have been a few times where you've suggested things and it's been really beneficial, like the volume profile. I forgot all about that until you brought that back up, and I've been using that every single week. It's one of my favorite indicators now. I like the standard deviation channel, I like the moving averages, and I like the volume profile. I think it's a great way to look at it. So I'm going to start wrapping things up here because I got to get out of it. It's about 12:30 now. Are there any statements, any comments, any questions, any stocks you want to talk about? Throw them into the chat right now, because I'm going to have to get out of here. I am going to be streaming again on Sunday to kind of wrap everything up and see what happens with the rest of the week. I'm working on some other content too. Hopefully that'll be out ready. I'm starting basically a newbie trading series. I've gotten so many people, or I've gotten so many questions about that. They say, hey, do you have something for people that have never traded? And I say, I'm working on that. So I'm getting that going. So if you know anybody that's just starting to trade, once that video series gets out there, it's probably going to be a couple of months, send it their way, man, because I need to get some more traffic. And I think it's good to start from the beginning. It's actually made me think about things in a different way, just defining terms that seem basic, and trying to get my approach down into like a readable format. It's been difficult, but at the same time, it's been educational. So I'll get those videos out pretty soon. I'm trying not to make them very long. Like I know the YouTube algorithm and all these places want these long videos, but I want it short, because when you're trying to learn, trying to jam a whole bunch of information down your throat doesn't always work out. I mean, you forget a bunch of stuff. So I'm trying to make it go slow and just give them the basic information and teach them how to research things on their own so they can become a better investor. And that's the whole point. It's like I want people to be able to make decisions on their own. It's not just about who's making a trade and can you copy them, because that's kind of dangerous. So it doesn't look like there's anything else in the chat. I am going to get going here. It was a nice day. Made that 25% profit. I'm very happy about that. The Fed was in line with everything. Let's see. Today is Wednesday, right? So tomorrow is going to be the GDP numbers, which is extremely important, although I don't think it's going to move the market very much. So we'll see if we're in a recession or not. That's the big question. Are we in a recession? Can we stop arguing about that? My guess is yes, we're in a recession. Let's get over it. So what do we got here? Barbarian Blast Machine. Have a good day, man. You too. I appreciate you coming in and checking out the stream. It's been fun. All right, I'm going to get out of here. I'll be back on Sunday at 3 p.m. Pacific time. God, I always forget. I live here. I should know that it's Pacific time, but I always want to say Eastern for whatever reason. Yeah, 3 o'clock Pacific time, Sunday. I'll wrap everything up. We'll see what happens with the rest of the week and get a game plan going. I'm still trying to get that schedule set up where I'm going to be doing an every other week thing, but until I get that set, there's going to be short broadcasts on some weeks. So I'll be there just to, talk about things real quick and get out of there. But every other week's going to be the full broadcast. All right, so I'm getting out of here. Have a good day. Be safe. Hopefully everybody else made some money or is going to make some money. Everything's in line, so we're good. All right, have a good week. I'll see you then on Sunday.